From tulips to NFTs, the wild history of bubbles and why we are not learning from the past. Imagine paying the price of a luxury house for a single flower bulb, or betting your retirement on a digital monkey JPEG. Sounds crazy, right? But that's exactly what happened in some of history's wildest economic bubbles. Today, we're diving into economic insights from history, from tulip mania in the 1600s to the NFT craze of the 2020s. We'll uncover the human psychology that drives these manias, relate them to today's digital asset hype, and share lessons to make you a smarter investor. Understanding these patterns could help you spot the next bubble before it bursts, and maybe even profit from it. If you've ever experienced fear of missing out, or FOMO, and then launched into buying a stock or crypto, this is for you. Our story starts in 17th century Netherlands with tulip mania, often called the first record speculative bubble. Tulips, exotic imports from Turkey, became status symbols. By 1636, rare bulbs were trading like stocks. Prices skyrocketed from a few guilders to the equivalent of a year's wages for a skilled worker, or even a fancy house. People quit jobs to trade tulips, using futures contracts, basically IOUs for bulbs not yet grown. But in February 1637, the bubble burst when buyers vanished. Prices dropped 99% overnight. Why? Pure speculation driven by herd behavior. Everyone jumped in because everyone else was getting rich. Greed and overconfidence made people ignore fundamentals. Tulips aren't scarce forever. Fast forward to 1720, the South Sea bubble in Britain. The South Sea Company promised riches from trade with South America, but it was mostly hype. Stock prices ballooned 10x in months, fueled by rumors and celebrity endorsements. Even Isaac Newton lost big. When reality hit, no real profits, it crashed, ruining thousands. Then, in the 1840s, Britain's railway mania. Railroads were the next big thing, like AI today. Investors poured money into hundreds of companies, many fraudulent. Shares surged, but overbuilding led to a bust in 1847, wiping out fortunes. Herd mentality and greed again. People followed the crowd without due diligence. Fear kicked in during the crash, causing panic selling. It's like piling into EVs or metaverse stocks because your friends are, but ignoring if the tech's ready. Enter the modern era. The 1929 Wall Street crash kicked off the Great Depression. Stocks boomed on margin buying, borrowing to invest, but overvaluation and bank runs led to an 89% drop by 1932. Millions became jobless. This time, the lesson learned was, don't go crazy with margin buying. Once again, herd mentality and greed. People followed the crowd without due diligence. Fear kicked in during the crash, causing panic selling, and then the margin calls followed. This led to the Great Depression of the 1930s. 1987's Black Monday. Global markets plunged 22% in one day due to computerized trading amplifying panic. Overconfidence in portfolio insurance backfired. This was the largest one-day percentage drop in US stock market history, far exceeding the 1929 crash. Sell orders triggered by automated trading systems led to a chain reaction of further selling as investors reacted in a panic. The crash demonstrated the increasing global interdependence of financial markets. By the way, I was working for a major brokerage at the time, and saw it unfold in real time. Then came 2008, the subprime mortgage crisis. Banks bundled risky home loans into safe assets that were sold to unsuspecting buyers. Mortgages were given to unqualified buyers, and rating agencies failed to do their jobs. This created a housing bubble where prices went way out of control. When defaults rose, it triggered a global meltdown, with trillions lost. Regulators and banks were not held liable, and taxpayers bailed them out. Fear and greed cycle. Greed inflates bubbles, fear pops them. Overconfidence bias makes us think, this time it's different, while herd behavior spreads the mania. Remember panic selling during COVID market dips? That's fear in action. Now, let's connect the dots to today. The NFT bubble peaked in 2022, with sales hitting $25 billion. Digital art and collectibles sold for millions, like Beeple's $69 million piece. But by 2023, 95% of NFTs were worthless. Crypto mirrors this. Bitcoin's 2017 bubble, from $1,000 to $20,000 then crash, and 2021's run-up followed by a 70% drop. Similarities to history? Speculation on new tech, without fundamentals, FOMO-driven hype, and herd rushes. Just like tulips, NFTs, crypto rely on perceived scarcity and buzz. Greed via quick riches stories, overconfidence in revolutionary assets, and FOMO from social media. Scrolling Twitter and buying a coin because Elon tweeted? That's modern herd behavior, same as 1637 traders gossiping in taverns. So, what insights from history? Bubbles form when psychology overrides logic. Greed inflates, fear deflates. The common threads are speculation, leverage, hype. This links tulips to NFTs. All the same pattern throughout history. Diversify, research fundamentals, ignore FOMO. Ask, is this sustainable? Do not rely on regulations or the government to bail you out. These aren't just old stories, they're warnings for AI stocks or whatever's next. By spotting patterns, you can protect your wallet. History shows we're wired for bubbles, but awareness is power. What bubble do you think is brewing now? Like if this helped, share with a friend who's crypto obsessed, and subscribe for more. Thanks for watching.